Welcome to Beyond the Press Release, on production of Agoracom, in which we take the time to speak with small cap executives after they put out important news. With us today, happy to have him back, Andrew Morton, CEO of Bloom Health Partners, trades in Canada under BLMH, for friends in the US under BLMHF. And for those new to the story, I'm going to give you 28 million reasons to love this interview. That's because the company has full year revenue guidance of $25 to $28 million already announced. So what do? They're a premium provider of operational health and health tech to Fortune 500, film and TV productions, and large organizations. So essentially, they're an end-to-end platform. That's what they're delivering, comprised of labs, clinical operations, and data that address the demands of modern workplaces and organizations. And more than just lip service, first, let's look at the numbers. Q2 revenue, just over $11 million, up 92% sequentially. And that's over Q1, which already was a knockout at just under $6 million. EBITDA for Q2 came in at just over $2 million. The balance sheet, spectacular. Cash on hand, about 1.7 mil, and receivables, another $8.7 million. But what's really important is why, and the trend that's underlying all this. For those of you who thought that outsourcing occupational health and safety was boring, well, not anymore, because major organizations, in fact, major organizations all the way down to small companies, are seeing health as a key driver of productivity in the years to come, and keeping employees, retention. Listen to what Larry Fink, the CEO of BlackRock, had to say in January. This is the new world of work. Companies not adopting do so at their own peril. A Fortune 500 company CEO and a client of Bloom said, "Replacing our aging workforce is more expensive than taking care of them. We're competing for talent with companies like Amazon that offer full benefits. Occupational health can solve many problems, and we can retain our skilled workers longer, attract the right people, and reduce insurance costs." It's big business. Bloom is delivering big results. Andrew, welcome back, my friend.
Hey, great being here. Thanks, George.
Hey, before we get to the numbers, how happy are you with this Q2 across the board? Revenue, profitability, balance sheet. How happy are you, and how happy should the shareholders be?
Well, I think the shareholders should be very happy. And for us as a company, this gives us that baseline to just keep on growing. We're now getting into new things, new partnerships, new clients, and we just keep building on it. And we're building on a really solid base. Feel really good about our year. Put out some aggressive guidance for the year, and we're delivering and executing what we promised. And it feels really good to be able to say that.
Which part of the finance are you happiest with? Because companies would, especially small cap, would love to have a great income statement. But if they can't have that, they love to have a great balance sheet. If they can't have that, at least they want to be growing. You're knocking it out across the board. Is there anything in particular you think shareholders should be focusing more than any other parts of that powerful financials?
I think the biggest one is the top line, because we're still in serious growth mode, and that always comes at a bigger cost. Just when you're growing a business and you're moving very quickly, it comes at a cost. That being said, we're executing and we're doing it profitably. It also has an indication of longer term where our profitability can be, and that's the exciting part of all this. As we grow, you've got to make reinvestments in the business, and clearly the results show some of that. I think longer term, we see the business growing into more areas, more places. We'll see that top line to continue to grow.
Where's that coming from, Andrew? Because you talk about, when you present the company, you talk about you provide these services to Fortune 500, film and TV production. Education is a big one because you just re-upped with the state of Texas K-12 schools. Is it evenly split? Are you seeing more growth coming from one sector, whereas more growth is going to maybe come from another sector? Where are you seeing it?
Traditionally, our biggest growth has been, in film and TV productions, Fortune 500. We did some of that. Of course, the K-12 was quite good to us this year as well. That being said, the biggest growth opportunities for us is Fortune 500, and that's primarily because of workplace health. And we've proven ourselves through what we're hoping is an endemic now, which is great. That being said, they all now have real concerns about keeping their employees healthy and looking for ways to attract employees. And that seems to be the biggest growth area. In my opinion, this is a generational opportunity where the employer now suddenly is dealing is very much a seller's market for employees. And they've got to do things to both retain and attract employees. And the best way they can do that is offering healthcare.
Well, and actually, that's one of my last questions, but since you mentioned there, I want to talk about that. Are we seeing a paradigm shift in end-to-end healthcare by employers and providing that to their employees and contractors and everybody else that's involved because of the competition in such a tight labor market? Or is this, or devil's advocate, could this be a 1 or 2 year thing and then things settle back down in the norm?
I think it's a paradigm shift because the expectations will be there. Once you lay it out, how do you go back on that? Especially when you look at what the next 5 to 10 years probably look like for the employment market. If you look at the actual supply of potential workers across, we'll call it US, Canada, we'll just keep it there, although Western Europe's no different, Latin America is no different. Baby boomers have all but retired. My generation, or our generation, George, sorry, Generation X, we're sort of a small generation. You remember at one time we were supposed to be that lazy generation. Clearly that didn't happen. We're all obviously doing our thing. Then, of course, you have Millennial and Gen Z or Gen Z here in Canada. And what we really have is a smaller generation in Gen X that's taking over for the baby boomers. That's an issue because there's just not enough of us. And we're aging. Let's face it. We're all kind of getting to our 50s, 55, some of us, at the higher end of that. Those are in many cases in a factory machinists that you need to keep healthy for a few more years because that apprenticeship of a Gen Z or a millennial can take them a little time to catch up. And then how do you recruit that person to want to take that job? Health can kind of keep them all there. So to me, this is 5 to 10 years out. And this is not a short-term thing. I think it's going to be at least through the decade. And I think that's why Larry Fink made that comment back in January.
Yeah, how timely, right as the Bloom business is growing. You had 92% sequential growth. Sequential, for those people who are maybe new to the markets, that's usually people talk about their growth over the same quarter a year ago, Q2 this year versus Q2 last year. You grew 92% over Q1, just the quarter before. I know you can't give specifics, but do you expect aggressive growth at your level? I know the industry, you talk about paradigm shifts, but do you have any reason to believe that won't continue, that kind of growth in the future?
Well, guaranteeing that kind of growth would be difficult to be able to guarantee that kind of thing. What I can say is we are bringing in new customers. There's new partnerships happening. There's lots on the hopper we haven't talked about yet. That being said, the 92% was quarter over quarter. Keep in mind as well, Q1, we typically our run rates typically a bit higher if you look at the previous quarter to that as well. But you kind of lose December. Companies aren't open, schools aren't open, so things are a little different. So keep that in mind. Having said that, we are definitely executing on the plan we've been promising people, and we're going to continue to push that. The growth for us is going to come from software revenues longer term, which obviously when you get to SaaS and that kind of thing, it creates a much longer and much more valuable business. That's the exciting part of all this.
I'm going to ask you a devil's advocate question, which is for anybody watching this for the first time, they say, okay, I see why Fortune 500 major film and TV productions need to incorporate this now. We get all the reasoning. Why would they go to Bloom Health Partners? Why wouldn't they go to George Com Medical, some big American conglomerate or a bunch of big American conglomerates? What's your answer to that as to why you guys are able to get in the door?
We're willing to innovate. I think that's the biggest thing. Traditional occupational health, and you called it out earlier, this is, I don't want to call it a boring business, but it hasn't changed in a couple of decades.
Yep.
And traditionally it has been the equivalent of what I like to call a school nurse. Somebody hurts their elbow, they go to the medic, and that's what they do. So they don't really associate the medical component of occupational health within a company with the confines of your office or your factory as a positive experience. It's kind of, it's where you go when things are bad. But if that place is associated with things like preventative care, this is a company that's taking care of me because they're actually screening me for other kinds of potential illnesses like diabetes, which is another epidemic on its own. Type 2 diabetes, unfortunately, is a major problem in the United States. 40% of Americans are considered obese. These are major indicators for longer-term critical illness. If an employer is taking care of their employee, now the employee has a better thought pattern to, hey, this is an employer that actually cares about me. I want to work here. I have my choice. I can make $15 an hour here or there. I think I'm going to go with the place that actually takes care of me. And I think that's what differentiates Bloom, because we're willing to layer those kinds of services. The bigger piece is that all of that information that's collected, obviously it's private information. You can't know individual data, but what you can know is overall stats on what's the viability of my business. Here's all my employees. They're all working hard and all of that. I'm screening everybody. I can't know that Fred over there has diabetes and Sally over there has, potentially cardiac disease. What I can know is what the risk is. How much risk is coming out of this organization? And then what do I have to do, from changing the vending machines all the way through to wellness programs? How does a business owner do that? And that's what differentiates Bloom's strategy versus, I think, pretty much everybody else in healthcare right now.
How do you make sure you get your employees stand-up desks so that George isn't sitting for 8 hours working for ABC Com? He's actually standing up for 2 or 3 hours or moving or all that. So I guess a great way to summarize, and I love it, is status quo. Your competition for the most part is reactive. Like you said, something happens that George's not feeling good, go down to the nurse's office and, oh, hey, George, it turns out you got diabetes and you're having, versus your solutions are proactive. You're watching George from now, you're helping monitor his health and knowing well in advance before he starts feeling dizzy that, well in advance, hey, you may have an issue. Let's take care of that. So what is it? An ounce of prevention is worth a pound of cure.
Without question, and predictability in the business. It's all about productivity from the worker. And if you have a happy workforce, it's a productive one. And if you look at, traditionally where the business has come from and how we grew and won some trust and built trust capital, all these companies and productions, kind of coming out of the COVID stuff, movie productions liked us a lot because we were willing to work around their needs. It wasn't one of those things where we said, we're healthcare, we know better than you. Here's the lab hours, here's these kind of things. We worked around what their requirements were. We've got to behave the same way with occupational health and what we like to call operational health. And you called it out earlier. Operational health is all about keeping a company running or an organization running. So if we're working around a business's needs, what's a good example? You've got an auto plant in the southeastern United States. Well, that's a very different kind of an operation than, say, like a ski resort in Colorado. Those are two totally different customers for us. They have different needs. They have different kinds of employees. And bluntly, they have different levels of health for their employees. It may be a slightly healthier crowd in Colorado, but they may have other needs.
Yep.
Where in the southeastern U.S., unfortunately, let's face it, you're talking about densely populated areas, low wage workers. Unfortunately, you've got to give them some services and maybe some nutritional advice that maybe you don't have to give to the ski bums in Colorado, for example.
So you could see, you could see growth out of Bloom for a decade, given that this is the new environment.
Well, the most successful companies always understand their customer, and I think that's what differentiates us from everybody else. As we look at what the requirements are and make sure we tailor things to fit their business requirements. There's a couple of different deployments we're involved in now that they're almost entirely opposite the way the deployments are working because they have to be, because the customers are very different. They have very different needs. Branch offices, small employees in one case, another case, very large, industrial environments with lots and lots of workers, in frankly close quarters. Those are two very different kinds of deployments with very different needs.
Devil's advocate again, what are your weaknesses or challenges? Because look, and by the way, every company from Google and Amazon right down to the corner store convenience, it doesn't matter if you're successful within your sector, you've always got some challenges you got to be aware of to make sure you manage those challenges. What are the challenges that you're facing and that you're managing? Doesn't mean they're fatal, but what do you see as the challenges for the company?
I think biggest challenges for us is just keeping up with the growth and continuing to do it profitably. At some point, we're going to have to make some more investments and do the right things to really grow the business, because you can't show up at a Fortune 500 with 500,000 employees unless you're ready to actually deliver. We're still we're about 70 employees today. We need to grow to be able to do that, to be able to address some of those, because there's more people we're not talking to than we're talking to, and we have to make sure that we can actually execute on that. The good news, I will say, most people are really suffering from employee shortages right now. What I have found is that to date, at least, we've been able to attract what I would like to call mid-career healthcare professionals successfully, primarily because we have something a little different to offer. Healthcare hasn't changed in a long time, George. And I think we experienced that last couple of years with pandemic problems, that if nothing, that exposed where the opportunities were for a business like ours longer term. We did short-term things in the pandemic, but it really exposed long-term opportunities for us. We're not competing with the hospital system. We're an augmentation of health specific to the workplace or the larger organization. And that seems to attract that mid-career healthcare executive or that healthcare professional, which is unique. But still, you can't do it from a flower pot. You can't just grow. You can't grow an entire garden from one little place. We have to grow. That's going to be our challenge.
And but that's where a healthy balance sheet comes in. Again, I'll repeat it. Well, about just under $2 million in cash on hand and receivables of just under $9 million. So you can call essentially $11 million, so $10.5 million on the balance sheet in cash and short-term liquid assets. How how much comfort do you take in that you know that if you need to make a few key hires or bring or expand your real estate or whatever the case may be, geography, that you've got the resources to make it happen?
We're in the middle of doing that now, and we'll do it strategically. So any announcements we make about growth or new offices, it's specific to customer opportunities that we're engaged in. And at the very least, because of our track so far, we're running a pretty good run rate year to date, which is positive. That being said, we're always watching our cash. You've always got to be careful with cash.
Yeah. Listen, there's no doubt about it that you guys are watching the books, because it's clear from the numbers. Geographically, Andrew, is geography play a role? Like, are your customers focused on the West Coast for now? Or can you have them spread out? Or do you need to concentrate in one area and then make a decision, say, all right, we've got the West Coast covered, now we're going to move to the East Coast or Central or whatever the case may be? How does that look in terms of your expansion plans in the future?
Well, we currently have coverage because we have labs in Texas, labs in Atlanta, and then labs in the northeastern US as well. So those three act as a backdrop. They traditionally started with doing testing and that kind of thing, but that testing is now evolving to other things like diabetes and blood panels and that kind of thing, because that's really the evolution of our business. It was very much by design, because the idea behind that was to have a hub system of labs, so that gives us the ability to control and innovate. We're not beholden to a third-party lab that does things a certain way. Obviously, everything we do is by the book, and it's FDA certified, of course. But if you really focus on those areas, those are pretty good geographies to work from. We're talking about large population base. In terms of geography beyond that, we want to make sure we get really good in the areas where we're focused first. And let's face it, corporate America has pretty good placing in those three regions. And within, you're a plane ride away from pretty much anything from any three of those very comfortably, or even an interstate drive away. So that's a pretty good place to start. We're also up here in Vancouver as well. So, obviously there's big opportunity in Western Canada, a lot of industrials, and the problems here in Vancouver are no different than they are in Texas in terms of employee problems. How do we attract employee? How do we make them stay? How do we make them want to be here? I think providing programs for that employee is the key to doing that.
Last question for you. The revenue guidance you put out earlier this year was obviously before the Q2 numbers. And again, you put out guidance of $20 to $28 million revenue for the full year. You're now halfway through Q1 and Q2. You're already at your 16.9, let's call that 17 million. A simple extraction of that means, 30, it looks like you're on pace for 34 million. Any plans to revise that number, or are you guys just going to play it nice and safe for now?
I'm really big on under committing and over delivering. I love doing that. I just think it's a much more responsible way to run a business. But that being said, we're feeling pretty good about year to date. At the very least, we're executing what we promised investors and we promised our stakeholders here in the company. We're gonna stay on track here. I'm feeling pretty good about the numbers. If we need to revise, we'll do that at that point if something extraordinary happens. But right now, we're sticking with our guidance.
No, and unless there's a big change in your business, I don't see, because look, I don't see, contrary to popular belief, I don't see the inner workings of every business partner of ours. But unless something really changes, you might be hitting that numbers as early as Q3. So I'm curious to see where we're going to end the year. Last word to you. You know what? We'd be remiss if we didn't talk about the fact that every public company runs two businesses. It's core business, which obviously for you is operational health and safety. But then there's also the capital market side, and the capital markets have been very difficult for growth. Let's remember that Facebook is down 50%, Netflix is down 65, 70%, and I think Shopify is down 80%. Even Amazon was down 33% year to date, and they've got the widest breadth of business, the most impenetrable moat protected business in the world, and they're down 33%. So you guys obviously have not been immune to that. Mind you, you've had a big week this week, which is great. But what's your message to shareholders when sometimes they conflate stock price with business strength?
I think it is an unusual environment. We're trying our best to not pay too much attention to it and keep running our business. We've heard from a lot of investors the last little while asking us what's happening, what's going on. Obviously, we couldn't talk about our results. And we kept reminding them, hey, look, we're staying in the course. We are going to execute what we promised we're going to do. And we've done that, which was, it's great to see that. And they get the message to shareholders and potential shareholders is we're really serious about running a real business here, a real brick and mortar business that has a serious digital component that has a lot longer lifetime value. I think the markets will take care of themselves. An old mentor of mine told me once, you watch that bottom line, the top line takes care of itself. And that's exactly what we're doing right now.
And let's not forget, I mean, a lot of people think you and I are really young guys, but you gave away our ages earlier. But you and I have been through .com. We've been through 2009. We've been through 2015 and even a touch of 2018. Fair to say that strong companies are the ones that survive, right? The ones that are executing. Bloom survives. Georgecom, gadgety gadget doesn't. Maybe a little thoughts on that, we'll wrap up there.
Well, there's always hype, and that's fine. And I did, to date myself, yes, I did live through the first tech bubble very early in my career. I was working at that time, coming out of 3Com, and was crazy enough to launch a business in the middle of all that successfully. And what I will say is, there's always that kind of casino talk in the markets, and that's fine. Let that happen. Without entrepreneurship, we wouldn't be anywhere. So I think it's great. People have big ideas. We've got to run a real business here. We're just running really on the heels of an unusual market right now. To me, this is a short-term situation, and I think the exciting part of our business is we continue to deliver what we're promising.
And the message I would give to shareholders is, it's not as if Bloom was looking to exit today anyways. You've still got, ramp up for growth for the foreseeable future. So even though it'd be great for all of us if small cap, share price across the board were higher, it'd be great. It doesn't make that big of a difference to Bloom, really, because it's not like you're looking to sell the company or exit for shareholders in the middle of 2022 anyways, right?
Absolutely. And we're focused on long-term value, George. I think that's a responsible way to run a business.
Well, and on that note, Andrew, congratulations. I think I speak on behalf of everybody, all shareholders, saying congratulations on incredible Q2, incredible first half of the year, and wishing you great success, and can't wait to have you back on in the next few weeks and months to see how you end up the year.
Great being here. Thanks for having me.
To everybody at home, you've been watching or you've been listening by podcast on Spotify, Google, Apple, your favorite podcast platform. To Andrew Morton, he's the CEO of Bloom Health Partners, trades in Canada under the stock symbol BLMH. For friends in the US, BLMHF. For those who knew the story, this is how you do your due diligence. Get to the company's profile page on Agoracom, because there's a lot going on here. It's a completely different business. A lot of you are used to Fortune 500 clients, film and TV production, education. There's a lot going on. We give you a great 1,000-foot overview so you can really understand what the company does, get comfortable with it, and then take that base knowledge, head right over to the company's website, do your deep dive due diligence, and hopefully today you discovered your next amazing small cap company. Thanks for joining us. See you next time. Hey guys, this video is over, but don't forget to help your company by liking it and even leaving a comment below. And then don't forget to help yourself by subscribing to our channel and never missing another great Agoracom small cap video.